Welcome to the Deep Dive. We are jumping straight into Healthcare Services Group, HCSG, and their Q3 2025 earnings call.
Right.
This one hit the wires pre-market October 22nd. And if you saw the stock move, you know this was not just another quarterly report.
Not at all. This was, a huge inflection point for them. It sent the stock to a new multi-year high.
It really feels like it transformed the entire narrative.
It did. It took HCSG from what everyone saw as this, long, drawn-out recovery story to something else entirely. Now it's a genuine growth story, but with a newly fortified balance sheet.
So let's get right to the numbers then.
Yeah, the numbers really speak for themselves. Revenue came in at $464.3 million.
Which is a beat, Rick.
A solid beat by almost $4 million. And that's up 8.5% year over year, which is, some real momentum in this sector.
But the bottom line, that was the number that really woke the market up.
Oh, absolutely. The GAAP EPS landed at an incredible 59 cents.
And the street was looking for what, 20 cents?
20, maybe 21 cents tops. So when you think about it, we are talking about a beat that on the surface looked almost impossibly large.
And the market reaction just showed how surprised investors really were.
It did. The stock closed the day up 13.8%.
And on huge volume.
Nearly 4 times its typical volume. And a move like that, it signals that capital's moving not just on, the excitement of one good quarter, but on a real structural belief that the business model is finally working again.
Okay, so let's unpack that 59-cent number immediately, because a surprise that big has to have a story behind it.
It does.
And the key here is the employee retention credit, the ERC.
That is the essential nuance, absolutely. This is where you really need to look past that big headline number.
So that 59 cents wasn't all from core operations.
Not even close.
Yeah?
While the GAAP EPS was 59 cents, it included this huge non-recurring benefit. Specifically, 36 cents of that EPS figure flowed directly from the ERC.
And that's a one-time thing.
Exactly, a one-time tax item. So it's critical for investors to separate that cash boost from how the actual business is performing day to day.
So if the flashy headline was 59 cents and 36 of that was the ERC, what did the core business actually deliver?
Well, when you strip out that 36-cent benefit and you account for a few other small offsets, the true adjusted EPS was somewhere in the 21 to 23 cent range.
Which is still a beat.
That's the punchline. Even after adjusting for that massive credit, the company still beat on core operations. So the momentum was real. It signals improving margins, better operating efficiency, all completely independent of that tax credit.
So the business health was stronger than expected anyway. But that ERC, it didn't just hit the income statement. It had to be a total game changer for their liquidity.
A monumental cash boost. Cash flow from operations was reported at $71.3 million. Oh. And if you adjust for a decrease in payroll accruals, the operational cash generation was actually closer to $87.1 million. But the key detail here is that the ERC benefit alone added $31.8 million to that operating cash flow, just in Q3.
31.8 million just hits the balance sheet instantly.
Instantly.
And to put that into perspective, how does that affect their overall liquidity position?
They finished the quarter with an incredibly strong position. We're talking $207.5 million in cash and marketable securities.
Wow. That is a massive cushion.
It's a significant amount of dry powder. It gives management this immediate financial flexibility that, frankly, they just didn't have 12 months ago.
And they used it right away to signal confidence, didn't they? The capital return program was pretty aggressive this quarter.
Incredibly aggressive. They showed a real commitment to shareholders. They bought back $27.3 million of common stock in Q3 alone.
So they're accelerating that $50 million plan they had announced.
Exactly. The 12-month authorization plan. And on top of that, they still have 3.1 million shares left under a previous buyback authorization. It confirms that capital return is a real sustained priority for them. They are putting cash to work right now.
Okay, so with this massive cash injection, impressive revenue growth, the question now becomes, long-term profitability. Let's talk margins. How did their cost structure look?
Right, so we need to look at their cost of services, or COS. This is their direct operating expense, mostly labor.
Always the key metric for them.
It is. The reported COS was 79.2%. Now, that's exceptionally low for them.
But it's distorted.
Very distorted, right.
Yeah.
The ERC benefit gave them about 680 basis points of, an artificial lift.
So if we strip that out, what's the real number? We're closer to 86%.
That's right. Normalized COS is right around 86%. And management's stated goal is to manage that COS back into that mid 86% range over the long term.
And is that sustainable? I mean, does that signal that labor inflation is finally under control?
Reaching and sustaining 86% implies that, yes, the labor market stabilization is real and their scale is kicking in. That 86% target, that's the key metric you want to watch for future profitability.
Okay, what about SG&A, the administrative costs? I saw that came in at $50.5 million, adjusted down to $46.8.
Right, or about 10.1% of revenue. Their short-term goal for SG&A is to keep it in that 9.5 to 10.5% range.
Which is a little higher than historical levels.
It is, and that reflects some necessary investments they're making in tech and sales infrastructure to kind of fuel that future growth.
Yeah.
But they're very clear that the long-term goal, which shows the real leverage in the model, is to drive that number down to the 8.5 to 9.5% range.
So invest now for revenue, then harvest the efficiencies later.
That's the strategy in a nutshell.
Okay, let's shift to that growth story, because this is really what's driving the stock's re-rating. Management said this was their 6th consecutive sequential revenue increase.
Right. And even more powerfully, it was the highest rate of growth they've seen since the first quarter of 2018.
That's 5 years, surpassing 5 years of momentum.
And that comparison to 2018 is so important. It frames this quarter not just as a recovery, but as a real return to pre-headwind growth levels.
And what did they say was driving it?
2 key things: accelerating new client wins and extremely high client retention rates. They're reporting retention at 90% and say it's still strengthening.
And when you get both of those moving together,
You get predictable, compounding top-line growth. It's the perfect formula.
so the sales pipeline is strong. You said it's split between environmental and dietary services, but what's the biggest single revenue opportunity that they have right now?
It's the cross-selling, and it is massive.
Okay.
So environmental services, or EDS, that's the housekeeping, the maintenance, that's usually how they get in the door with a new client.
Right. Their other segment, dietary, the food service, is still only about 50% penetrated within that existing EVS customer base.
So half their current clients are only using half their services.
Exactly. And the monetary implication of that is staggering.
How so?
Well, on a same-store basis, a dietary account brings in 2 times the revenue of an EVS account.
So if you win a dietary contract from a client that already has EVS, you've just tripled the revenue from that one facility.
You've tripled it. So capturing that remaining 50% is like this low-hanging fruit with a 2x revenue multiplier. It's a huge internalized growth engine. They don't even need to win a single new client to significantly boost revenue.
That's a powerful position to be in. And that focus on organic growth seems to dovetail with a kind of a subtle strategic shift they announced on M&A.
Yes.
They're not just calling the education segment education anymore, they're calling it campuses.
That change in language is very deliberate. It signals strategic flexibility. By broadening it to campuses, they're opening the door to adjacent markets. Like what? Corporate dining?
Corporate dining, other specialty health facilities, different education models, basically anything that fits their core operational profile of managing large, complex outsourced services. They're looking beyond their historical comfort zone.
And that's especially important right now with all that new cash on the balance sheet.
That's the connection. Because the campus initiative is, without a doubt, management's #1 target for M&A.
Even though it's tiny right now, less than 5% of revenue.
Right. But they see it as the clearest path to rapid diversification and growth. They want to use that fortified balance sheet to execute bolt-on acquisitions and instantly scale up in that adjacent area.
And this all lines up with the broader industry backdrop, which is finally firming up. We've talked about labor as a headwind for years, but management seems pretty confident now.
They were very explicit about it. They said labor availability and wage growth have stabilized. The healthcare sector is actually leading all sectors in hiring right now.
Which lets them staff their facilities.
Efficiently, yeah. They've secured the staff they need, both at the facility and management level. They even said their application levels are at record highs, which suggests they're seen as an employer of choice.
And that stability directly helps their clients, which is the key driver for demand.
Absolutely. The biggest tailwind for HCSG is their client census. How many residents they can actually admit.
And if their clients are fully staffed, they can take in more residents.
Exactly. The skilled nursing industry is projected to reach pre-pandemic staffing levels by mid-2026. That allows their clients to open more beds, grow their occupancy, and that drives higher demand for HCSG services. It's a classic rising tide lifting their boat.
So you've got the demographic tailwind, rising occupancy, and now stable labor. The whole foundational story is strengthening.
That's the summary right there. The core market is benefiting from constrained new supply, those demographic tailwinds, and improving operational metrics for their customers. It all points to an environment that supports sustained growth.
Okay, before we get to the outlook, let's just quickly touch on the one persistent risk, the Genesis healthcare situation. What's the latest there?
The update was reassuringly boring, which is what you want to hear.
Right.
HCSG is still providing services to Genesis facilities without any disruption to operations or, importantly, payments. They're treating it as business as usual.
And the bankruptcy process itself.
The bid deadline is early November, sale hearing mid-November, with a potential close maybe late spring or summer 2026. For HCSG, it's a managed risk that's just slowly rolling toward a conclusion.
Okay, so let's look forward. What did management guide for Q4 revenue?
They gave a range of $460 million to $470 million.
Which implies that this growth is sustainable.
It does. It implies continued steady sequential growth from Q3, which validates all this operational momentum we've been talking about. And the long-term target is still that mid-single-digit top-line growth. They're confident they can keep this up.
So if you're assessing the sustainability of all this optimism, what's the overall health check?
I mean, the broad-based beats, the much cleaner revenue and cash flow trends, it all signals true operational health. And that aggressive capital return policy, that's management signaling. They believe this is a sustained recovery, not some temporary blip.
What's the one primary risk then? What could derail this positive story?
It's still labor. Despite the current stabilization, the number one concern is labor cost inflation. If wage growth suddenly reaccelerates in the healthcare sector, it could really pressure their path to that 86% cost of services goal. It remains the top thing to watch.
All right, this brings us to our high conviction segment. We've covered the data. Now we're going to frame an outrageous but plausible trade idea based on what we've just analyzed. And just to be clear for everyone listening, this is strictly for educational purposes to help you connect the dots. This is not financial advice.
And my pitch here relies completely on the strategic use of that unexpected cash flow from the ERC.
Okay, lay out the thesis.
The thesis is this. The massive, unexpected cash influx from the ERC, that $31.8 million in Q3, which brings the year-to-date total over $50 million, that will act as an immediate catalyst. It's going to significantly accelerate their number one strategic priority, which is M&A and that nascent campus vertical.
So you're saying the one-time cash event triggers an immediate structural change in their growth rate. What's the trade?
The trade is long, HCSG. It's based on a rapid multiple re-rate that's driven by this inorganic growth and a huge boost to their execution credibility.
Okay.
Look, management has publicly stated campuses are their number one M&A target. With this fresh, non-dilutive cash, HCSG goes out and executes an immediate bolt-on acquisition in Q4.
Something small to medium, big enough to matter, but not so big it disrupts the core business.
Exactly. This Q4 acquisition would instantly demonstrate the power of their cross-selling model in a brand new end market, without having to wait years to build it organically. This successful, rapid deployment of capital immediately shifts the growth narrative away from the one-off ERC boost, and it forces the market to assign the stock a higher forward multiple. It shifts its valuation from a recovery story to a real growth services story.
And the ultimate risk is what? They fail to deploy the capital or they make a bad acquisition?
Those are the checks, yeah. A misstep in M&A could burn that capital and destroy the new narrative. But the opportunity to seize this momentum, to use unexpected money to pivot from cleanup to expansion, that's what makes this so compelling right now.
That was a tremendous deep dive. To recap the key highlights for you, we saw strong Q3 top-line growth, which indicates a return to that pre-headwind momentum. The huge cash boost from the ERC has fundamentally fortified the balance sheet.
Which enables that aggressive capital return and M&A capability.
Right. And crucially, the labor environment is stabilizing, providing that necessary tailwind for their clients to grow.
It's a powerful combination of financial strength and operational execution.
So here is a final provocative thought for you to chew on. If we look at the core market that HCSG serves, less than 15% of identified candidates currently outsource environmental services.
And even less for dining.
Less than 8% outsource dining. The ultimate prize is the 85+% of the market that still does this stuff in-house. So the question is, given this newly enhanced balance sheet and renewed management focus, How quickly can HCSG use this newfound stability to truly seize that remaining massive market opportunity?
That's the ultimate ceiling on their valuation right there.
Indeed. We appreciate you diving into these sources with us today. We'll catch you on the next deep dive.